Europe agrees to offer a second large bailout to Greece. I'm Catherine Rampell, reporting for Business Day Live. First, here's a look at headlines. Investors are keeping a close eye on the Dow Jones Industrial Average today, as it is close to breaking a psychologically important barrier. Although 13,000 points is ultimately an arbitrary high watermark, it would be the highest point the Dow has reached since the financial crisis in 2008. Walmart's profit fell short of analyst expectations. Still, this was the second consecutive quarter the company turned a profit after more than 2 years of declines. The retail giant was helped by holiday sales. And Home Depot said that warm weather and an improving job market helped bolster its sales, which increased by 5.7% for the year. European leaders agreed to bail out Greece for the second time. The terms of the deal: austerity for Athens and a loss for bondholders. Joining me now from Paris to discuss the deal is Liz Alderman. Hi, Liz.
Hi, Catherine.
Thanks for joining me.
Thanks for having me.
So first things first, what's kind of the big picture here? What does this deal mean for the stability of the Eurozone, for the future of Greece?
Well, as you mentioned, this is the second bailout that Greece has had to get within the space of 2 years. And there was a lot of strum and drang surrounding the final negotiations here. They now basically are on their way to getting $172 billion worth of aid, which is expected to carry them toward the future and also should allow them to avoid a default on billions of euros worth of bonds that are coming due next month. For the moment, what this basically means is that Greece theoretically is going to be able to avoid that default that I was talking about. But the picture gets murky when you look at the details, because effectively the Greek government still has to pass laws that would implement the austerity measures that they have agreed to.
And what kind of austerity measures are we talking about here?
The government is going to be doing everything from reducing salaries further in the private sector, lowering the minimum wage, sharply cutting defense spending, and it's also going to have to try to make good on pledges that it has made for 2 years to start to collect more taxes in order to fill this gaping hole that it has on its accounts.
So
that is.
Well, I was going to say, so we've heard about Greece having to implement austerity measures before. What's the likelihood that this new batch will actually materialize?
I mean, that's the billion-dollar question here. They have certainly, the people in Brussels and the IMF, Christine Lagarde, everybody, including the Germans especially, has doubted Greece's ability to do this, because they have certainly shown in the past that they haven't really been able to come through this. We also saw a lot of opposition lawmakers resigning in the past couple of weeks, those who basically argue that austerity is going to lead the country further toward economic destruction. So while the politicians are pledging that they are in fact going to push this through, that still remains to be seen.
So there's likely to be some pain on Greece's end. What does all of this mean for bondholders?
Well, the bondholders, the banks that hold Greek bonds, have agreed to take a very large haircut, the equivalent of about 75% on the bonds that they held. That should, be a one-time deal. That being said, there could be a number of bondholders who decide at the end of the day that they don't want to sign on to the agreement, which would create new trouble, because it would mean that Greece would go ahead and try to unilaterally impose losses on hedge funds and others who wouldn't have signed on to the agreement, which would effectively constitute sort of a controlled default. So that's something that markets are going to be watching out for very closely in the coming days.
There's also a lot of concern about financial contagion in all of this. I mean, there has been for now several years. What does this deal do with regard to a firewall, and how would that work to protect basically the spread of any problems within Greece?
Well, the one thing that is different this time around is that politicians in Europe seem to have succeeded in calming the fever that had gripped financial markets really for the last almost 2 years on this issue. Previously, the concern was that if something happened to Greece, that if Greece were to default, for example, that perhaps other countries that were in trouble, such as Ireland or Portugal, might follow suit. Now the rhetoric is that people are convinced that Greece is basically sort of a standalone case. So the contagion effect is significantly diminished. And at the same time, next week, European leaders are going to be meeting to try to come up with ways to pump more money into a mechanism that they set up, that a huge bailout fund that basically would act to protect other large countries such as Spain or Italy should the financial markets put them into a position similar to the one that they had pushed Greece into by raising interest rates on them because of concerns about their economic and financial situation. Again, that is looking much, much better. And with the erection of sort of a new firewall, this new fund, leaders hope that that will hopefully keep a lid on things.
Well, thanks, Liz, very much for joining us again.
Thanks for having me.
Here in the United States, the political battle over mortgages has resulted in a few concrete steps. Later this week, the government is expected to unveil new standards for how banks deal with homeowners who are facing foreclosure. Nelson Schwartz, a financial reporter, has been covering this story, and he joins me now. Nelson, thanks very much for being here.
Good to be here.
So this is not the first such deal where, some government entity has gotten involved in trying to figure out how to make the whole mortgage mess go a little bit more smoothly, right?
Absolutely. I think for veterans of the mortgage mess, this probably has a little bit of air of deja vu, if you will. A year ago in April, the one federal regulator, the Office of the Comptroller of the Currency, reached an agreement with many of the same banks as the deal we just had earlier this month to kind of make a lot of the same improvements, and it's been very, very slow about getting those actually implemented. So we're kind of doing it again.
What kinds of sticking points have there been?
Well, one key goal of both the settlement earlier this month and the deal a year ago was to have a single point of contact. So if you're facing foreclosure, you've got a name and a person at the bank you can call. They return your calls, you deal with them. You submit the documents to them so they don't get lost, but easier said than done.
And this has continued to be a problem, people getting
exactly
shuffled from one contact to another.
Yeah, I've talked to people, there's sometimes they'll get a single point of contact, think this is great, and the next week they'll get another single point, a different person, and another one, and another one. Other cases, they'll have that single point of contact, and that single point of contact doesn't return their calls. So there's a lot of frustration out there. And again, these settlements are supposed to make it better. That hasn't happened yet.
So why has it been the case that these types of settlements and other deals have not significantly improved things? Is it a matter of willpower, or the banks are, just trying to pull a fast one on everyone? Is it disorganization? What's going on here?
I think it's definitely some disorganization, and I think 3-4 years into the, bursting of the housing bubble, the banks are still overwhelmed by the millions and millions of people who are behind on their payments, delinquent, facing foreclosure. They've definitely thrown a lot of resources at it. They've hired a lot of people, but I think they're still behind in terms of just the amount of claimants coming in there and people who can't pay their mortgages, looking for modifications, that kind of thing. And it's going to get worse.
Well, yeah, I mean, now that we have these new settlement guidelines that are coming out, servicing guidelines coming out, how is that going to affect this whole picture?
Well, the servicing guidelines have pretty strict rules about what the banks are going to do. They definitely are tougher. Plus, you've got about 1 million people who are now eligible as part of this recent settlement. They're eligible to get their principal reduced or to get lower refinancing rates. And for people who were evicted from their homes, they are eligible to get between $1,800 and $2,000 payments. People have already been foreclosed. That's going to create a tidal wave of people going to the banks for help.
And they're already overwhelmed, right?
Yes, exactly. So I think that's why I worked on this story, is sort of like, let's, as excited as everybody is about the settlement, let's, exercise a degree of caution or, skepticism before we celebrate.
Well, are there certain elements to a deal or policies that would make it more or less likely to be successful, given this history of I don't want to say botched deals, but deals that have not fully lived up to the expectations that a lot of people had for them?
I think this deal, one reason for optimism, according to the backers, is that you've got much stronger enforcement mechanisms. In sort of some of the other deals, the only way of enforcing it was to go back to court, file a new lawsuit. Here, you've got an independent monitor, full-time, making sure the banks live up to it. You've got a bunch of federal agencies taking part, along with state attorneys general. So you've got a lot of people keeping their eye on the banks. Hopefully that'll be enough.
All right, well, Nelson, thanks again for joining us.
Good to be here.
That's all for today. Please remember to join us online at nytimes.com for our continuing coverage of this and other stories. I'm Catherine Rampell, reporting for Business Day Live. Thanks for watching.